Good evening, everybody. It's Richard Bowser here, editor of Property Investor News, and thank you for joining us on what is our first webinar. It's the second webinar in May. Tonight, the agenda. We've got an introduction, which is what I'm doing at the moment. We've got Karl Griggs, who's a very experienced finance mortgage guy from CPC Finance. He's the co-founder of CPC Finance, and they are tonight's sponsor. Then we've got, after Karl's done a presentation on the current marketplace in terms of lending, but we're going to have a presentation from John Corey, who many of you will know. John's been writing for Property Investor News probably for more years than he cares to remember. And I've known John for many, many years, and obviously subscribers really do value his sometimes left field opinion on the market, but I know his opinions and it is very, very valued by a lot of people. So of course, John runs the London real estate property meeting, which I think took place last night in central London. What it would have done if people had been able to get there, but it obviously it was a virtual meeting. So after John's short presentation and some slides, we're then going to go over to the main part of the evening, probably for about 30-35 minutes, and we're going to talk about two articles from each from John that we featured in the magazine in both the April and the May issue. For those of you who don't know, all of our webinars and have been for quite a number of years now, they're always recorded, they're edited slightly, and then they're hosted onto the magazine's website in the webinar section that you will need password access to log on. So those of you who are guests on board tonight, if you want to get access to those dozens and dozens of webinars and some of the high quality videos that we've also produced in the last 5-6 years, where we feature investors, developers and landlords at their projects, then you need to subscribe to Property Investor News. That's the website. Go and have a look at it, those of you who are not sure. I'm just going to run through a couple of slides, which is repeating what I said last week. Obviously, you know, this is I'm trying not to use the word unprecedented, but it is an extraordinary period we are going through. How long we're going to go through the impact of Covid-19 remains to be seen, and obviously it's truly tragic for many people. But at the same time, you know, life has to go on. How unique are your property assets in your investing locations? What are the barriers to entry for others? How easily can your business model be replicated by others, by new competitors, or is it pretty unique in terms of your offering? How robust is it? How secure is your cash flow? Well, obviously, as we will touch on later, there are sections of the marketplace, as probably most of you will know, and we touched on this in the April magazine, where the business model, which may well have been working very well, the serviced accommodation is one that springs to mind, isn't at the moment. It's you know, put certain sections, a good section, part of the serviced accommodation market is obviously experiencing significant difficulties in terms of occupancy. If you're in the construction and build, refurb, development, then it's about your supply chain of staff, of contractors and of materials. And although it's opening up a little bit now, I don't know, some of you may have seen the Instagram post or Facebook post that I put up last week from our offices. And our offices in Elstree overlook a plant hire yard. Normally that is, you know, the stuff in and out, but for the last 6 or 7 weeks, it's been completely full of machinery unhired. Obviously, that's starting to change a little bit in the last week. Going back to us as property investors, landlords, developers, how secure is your cash flow? Obviously, the government has been putting out helicoptering confetti to some extent. Some people, unfortunately, are falling through the gaps. But I mean, I cannot remember in my lifetime, or even in any time in history that I can recall, where government is being that supportive of businesses and of individuals. I mean, this is completely unlike the 2008 situation where it was all about banks' liquidity and banks going bust. The banks are far more robust in terms of their balance sheets than they were, thankfully. So government, in my opinion, at the moment, they've made lots of errors, particularly on the health side, health protection side. But I think, in terms of financial support, you know, a lot of people are thinking, actually, you know, this is fairly impressive. So yeah, you know, it was that's the wrong slide. That should say whatever it was, X number of weeks since the April edition, but it's now 10 weeks since the March edition, when this whole 9 weeks, whatever it was, since this really kicked in and locked down. And yeah, we, as I said already, we've managed to get through. We've produced the April magazine, and the printers are going to be knocking out printing. They've already printed it. It's just the finishing process is going on at the moment, and it'll be going out to subscribers later this week. Just touching on what I do personally, some of you know I don't do anything complicated with my rental portfolio. I just do single lets, and they're mainly up in the northeast. So at the moment, I'm quite happy. I've got no voids. I'm seeing some of my single lets which are let to housing benefit tenants. On a couple of them, the rates went up reasonably well. I've got no voids, and yeah. So I'm okay. But lots aren't, and I'm well aware of that. So in the May magazine, which you'll be receiving, which I've already mentioned, dealing with lockdown, we've got 3 interviews with developers and serial landlords, talking about what they have been experiencing in the last few months and how COVID-19 has impacted on their businesses. Lots of lessons there potentially to pick up from, some positive stuff and some not so positive stuff. There's a review of the industrial, logistics and warehouse sector with a couple of interesting conclusions. What's ahead for property is, I think there are 3 specific articles on what's ahead for property in the May magazine. We've got another good piece from David Kemp on planning. We're not doing FDI trends in this issue. That should have not been there. We are doing a big piece on climate change and property, and that is something that may well take your mind for a little while off of the impact of COVID-19. So that's enough for me for now. If you're not a subscriber to Property Investor News, this is a 10-second sales pitch. It's all about keeping yourself up to date with the market and adapting and learning, ongoing education. That's what we offer. £7.95 per month is the charge, direct debit, and you get all the access to all of the articles, the videos, the webinars, and just, you know, the bottom line is the bottom line. Time is money. Use your time and money wisely. Right, Karl, are you there, sir?
Yes, I am. Yes.
Good evening. So we've now brought on board our first presenter tonight, and it's Karl Griggs from CPC Finance. So thanks for joining us, Karl, and over to you.
Thank you very much, and good evening, everyone. Just start with a little bit of a background of CPC Finance. We're directly authorised mortgage broker that, as it sums up, deal in both residential and investment mortgages, commercial, short-term finance, development, but anything that's really secured on property and land. We don't regularly advertise in the broker market. We rely heavily on our investments and repeat business due to the service and facilities that we offer. That's who we are. My name is Karl Griggs, and I'm one of the founders and directors of the company. And we'd like to build our service based on the personal service with the individuals. What I've done for this evening, in light of the ongoing situation, is break it into 3 sections, which, as it says on this one being the past, what the finance was pre-COVID, the present, i.e. while we're in this position, and then what's going to happen in the future, if anybody does know, but we'll try and sum that up. So what we've done in the past is help people build their portfolios from 2-3 properties up to 20-30 properties by using short-term finance, development finance, and then terming the facilities out at the end. And we've got an example of something like that, which I'll come to on the next pages. What's becoming clear now is, and will, I believe, it get even harder, is the amount of paperwork that the lenders on the investment side mainly are going to be asking for. And what we like to do as part of our service is consolidate and keep updated all your information on your portfolio. So when you buy and sell a property, not necessarily through us, or we don't arrange, but if we keep updated, we can keep the schedules up to date. Something called eTech, which some of you may know, is what the online service that a number of lenders are now signing up to help them underwrite a deal in the background, and makes it simpler for them on the stressing of the portfolio. We offer visits to your home or to your properties to meet you face to face and complete any paperwork, and obviously that includes then we can certify ID for lenders and certain things like that. We don't, apart from loans under 100,000 to cover costs, we don't charge a broker fee. And what we look to do is rely on repeat business because of the service that we give, and make it easy for you to do your job, which is to find properties, do the build, and move on with get it transferred over into an investment. You do that, we do the finance. What we like is that people ring us up, say, yeah, found this property, this is what I'm doing to it, sort out the finance on it. You leave that to us. We work together with your solicitors and create a team network. And that's where we've got to and built our position in the market where we are. I've just got now an example of what we do, or what we try and encourage as part of the project. So this particular client came to us with a property. It's a 3-bedroom house. This is the layout it came in at, and what he wanted to do was spend money on it to convert it. And this is an unconventional built property. In the bottom right hand is the best picture of it. It's non-conforming construction property, so we're limited where we could go, and also that it was going to be refurbed. So the clients paid £340,000 for this, and they wanted to spend a lot of money converting it into a 5-bedroom HMO. As a single let property, it's okay, it wouldn't have got a lot, but also more importantly, the structure would have limited the market where he could go for the mortgage. Right. What they converted it to was a 5-bedroom HMO. This is the new layout compared to the previous plans, but this is the start of a virtual tour, but it gives you an idea of what they've done. They've done a rear extension and converted it upstairs and downstairs, and spent approximately another £80,000 on the property. So overall, that includes ensuite bathrooms in each of the 5 bedrooms. Overall, they spent £340,000 buying it, £80,000 on work to convert it. This is the end result. Now, one of the big costs was they put a new skin on the property with a certificate and warranty, and made it mortgageable as a property. Also, at the time we completed on this, as included in the £340,000 was the parcel of land on the site. When we completed on it, we actually split the title. So the actual 5-bedroom HMO didn't include all the land on the site. And what the end result is that this became a 5-bedroom HMO valued at £460,000 when it was completed. So it paid off the short-term loan and got all his refurb costs back out. So all he had left in it was his deposit. But also on the side of that, he had the land on the side, which is separate title, mortgage free, and then he can build another property on it. So the overall, from what it started being the unconventional property, has now income producing of £35,000, and he's ended up with the land mortgage free as well to build another asset on which we can fund for him as well. So that's the sort of short-term to term building the portfolio that we like to do. Right, present. Now this is written sort of, yeah, well, this was written before today. So there has been some slight movements on this. So since the COVID, we've been obviously restricted loan to values in light of not being able to do internal valuations by the valuers. So a lot of this has been based on AVMs, online valuations, desktops, or unfortunately in some situations not being able to go any further with applications because we can't do the valuations if there's work involved. So what a lot of the, particularly the bridging side, have restricted borrowings down to 65%, some 60%. And then in light of that, the mortgage side has also been reduced down. On top of that, on the investment side, there's been a very much reduced product range available across the market. Obviously, some lenders not lending, some reducing their products down by over half, and in some cases even increasing some of the existing rates, which, you know, is sort of the position we were in before being able to do surveys. On top of that, there's been a lot of delayed service by the lenders because in the background they are also dealing with a lot of phone calls in respect of holiday payments and servicing of their existing book. So in light of the reduced loans, they've concentrated more on their existing book to try and give the service to the ones that need it. And this has affected a lot of applications. Now, you've got the situation where online valuation and desktop valuations are based on a general market. So I personally don't believe that that will give the true value of a lot of people will think their asset is worth. It will just be a generalized figure. So that, along with reduced loan to values, will give, particularly if it's a purchase, will give the client a position where they've got a lot larger deposit in than they were originally expecting. Something, you know, from instead of putting in 20-25%, they're probably going to be putting in 35 to 40% if they were committed to the purchase, as some were caught up in buying auction properties during the last 6 to 8 weeks. The future, well, the first one's starting to happen with the valuers being able to now go out and value the properties. Today, and numerous lenders coming out saying that the valuers are back, although that now means there's going to be a backlog for the valuers. They are increasing some of their LTVs. So over the next 2-3 weeks, as long as there's no spikes in COVID, all we can see is the loans of values and the rates going back to where they were. There has been a real reduction in products. I noticed last couple of days that there was some data released by Moneyfacts saying that in March there was over 5,000 residential mortgage products, and at the start of May there was just over 2,500 products. So it's virtually halved in the period of COVID, which has affected a lot of people. I believe going forward, there's, on the investment side particularly, there's going to be a lot more paperwork involved with portfolio landlords. The business plan is going to be looked into a lot more stringency than it has been in the past. How, or if you've got funds available to cover future voids if something like this happens again. And what we're all learning in the last 6 to 8 weeks is the IT side, i.e. the things like Zoom and actually lenders, instead of going out to meet clients, having more Zoom meetings or recordings or using IT to actually get a feel for the client and rely more heavily on a personal underwrite, which again goes back to what I was saying earlier, that this will delay the processing time of the mortgage applications. Also, which was the hot topic at the moment, holiday payments. Have people applied for it? Why did they apply for it? Some lenders won't do further borrowings on holiday payments with their own portfolio, but other lenders criteria state that they won't do any loans or offer any facilities for anyone that's had a payment holiday on any of their portfolio. So this is all new information that's going to be digested and become part of the processing system going forward. They will ask for, I think they're going to ask for the 3 months bank statements to cover this period to see if people have had payment holidays. If they have, were they genuine? i.e. were their mortgages still being paid? Rents coming in, but they're not paying their mortgages. Did they apply for the holiday payments for the right reasons? And this will be all part of the process going forward. But the knock-on effect to that will be that this will be a delayed service from a lot of lenders, because it will become more of a manual underwrite rather than the online underwrite. So the processing and service times, unfortunately, that we will receive will be longer than what we've been used to. And it will be a more, in some ways a good thing, in some ways a bad thing because of deadlines. But the good thing about a manual underwrite normally is that they take a more pragmatic approach rather than an online yes or no decision. And I think that's where the future will start to go. And that's really covering off the past, the present, and parts of the future. So that's my bit today. And back to you then, Richard.
Thank you, Karl. So, Karl, if people want to get in contact with you, we'll push those details out without question, as there's nothing on the screen there. So let's just see what we've got here in terms of some questions over. Looks like there's quite a few, Karl. So get yourself ready. You touched on one about holiday payments, and I think you might have touched a bit on about underwriting. One thing we were talking earlier, I just made a note about, how quickly loans to values might return towards the pre-COVID crisis levels.
The overall problem at the moment, even with valuers going out today, is within their reports, what comparable evidence are they going to use? Now, if they're going to use the pre-COVID, are the lenders going to be happy to accept that or restrict the loan to values because of that? Unfortunately, there isn't now a track record for the last 2 months for them to give confident comparables within the report. And one of the other things which could have a knock-on effect of this is we're hearing also is that the valuers with their PI cover, some obtaining it, obviously it's been increased, and could it price some of the valuers out the market as well? So it could be a smaller market of valuers to value the same amount of properties, and the costs go up as well as not being able to get the information that is required, because I can't see, obviously normally they ask for sole comparables within a set period. Now there's going to be a 2-month void. It's how the lenders react with the confidence to lend against the reports that will push the loan to values up. They happily lend, I believe, going back to the old levels, but of what figure supplied by the valuers, which is, I think, where the problem will come.
Okay, hope that's helped a few people there. So on to the first question from the audience tonight. There's a lot of you. This is from Chaim. I hope I'm pronouncing that right, Chaim Landau. He's asking, what's your view, Karl, of the market after the furlough extension up to October? Well, to some extent you've touched on. Will existing lenders retract or even reduce loans to values? I think you've already pretty much covered that.
I think it's an unknown market at the moment, because on the other side of the property, obviously you've got the residential first-time buyers, the residential market, people moving up the channel. I don't know yet how the lenders are going to respond to the underwriting of those. And what I mean by that, if you take one section, which is the self-employed section. Now, pre-COVID, it was, they wanted either 1 year or 2 years tax computations, SA 302s. Now, the problem is they are going to be looked upon, that's last year's figures now. Now, with COVID, what is their yearly income going to be? And what income proof are they going to rely on and ask for? And on the employed side, people that relied on overtime, bonuses, etc., are going to have a 3-month void, so their year-to-date income isn't going to be what it was. Now, our lender's going to say, well, we're going to ignore those 3 months and just go on the old figures. But, you know, again, if people are furloughed, their income on their payslip year-to-date is going to go down in some cases. And therefore, the knock-on effect of the affordability calculations could slow down the residential market, which in turn will then knock down the values, because people can't get the loan, the 5 times income levels that they were expecting. But on the other hand, it could open up a market for investors, because people can't move, they rent. So unfortunately, it's the unknown at the moment on the income side with the residential.
Okay, that helps on that. So question from Richard Carrison up in East Anglia. I know Richard well. He's asking, which to some extent you've already answered this again, but which is, you know, is a mortgage holiday like a red flag in terms of what it says about the borrower?
I think what's happened, and it's only my opinion, the terms coming out, or the way it was presented at the government, it won't affect your credit, is misguided, because it won't affect your credit file, but it could affect your mortgage or your credit going forward with applications. And that wasn't separated and made clear. If the lender, I've heard lenders' views say, well, if somebody's on a payment holiday now, why are we going to lend them more money to put them financially in a worse position? But then the real reason for the payment holiday, which is what I touched on earlier, if tenants generally don't pay, then they are entitled to the payment holiday. But I've also heard that some people have been applying for payment holidays and their tenants have been paying, but they've used that money for other areas of their business. That isn't what the holiday payment was brought in for. It was purely to cover the mortgage side or the rent side for the tenants. So it's the unknown. Again, unfortunately, I'm not trying to hide from the question, but it's how lenders are going to interpret it, not the credit file. And that hasn't been laid out by anybody. I've seen some lenders, as I say, who won't lend while people have properties or some of their properties in a holiday payment period. And some will say, well, once that holiday payment stops and we can prove they're getting their rent back again, then that will be done. The other issue on it, as I said, is when they ask for the bank statements and their property schedule, and they can see that all the rents have been coming in, it shouldn't have been on a payment holiday, and no mortgages have been going out. So that's the scenario. And I do think that somewhere along the line, the lenders should have done more search before they've given the payment holidays, but they've been under so much pressure from the government to do it that I don't think they have done the background work correctly in some cases.
Okay, Karl, I hope that answers some of your question there, Richard. Got another Richard on the line who I also know very well, also a very experienced landlord. We featured Richard Spong in a magazine quite a number of years ago. Good evening, sir. Richard Spong is asking, as a detailed question, this one, Karl. He's going, the most competitive buy-to-let mortgages are not available to landlords with more than 15 mortgages. Do you see this changing? What recommendations do you have for professional landlords looking to remortgage some of their property?
If we split the question into 2 sections, the first question is, up until pre-COVID, the lenders didn't want to know people. On average, professional landlords or portfolio landlords that have got more than 10 properties. That was sort of the guideline, that they liked them between 4 and 10. I personally believe now it will switch, because the bigger the portfolio, the more spread you could have, particularly if you've got multi-let properties, blocks of flats, student accommodation going forwards in that portfolio. The income across the portfolio as it's run as a business will be more appetizing than somebody who's got 4 single let properties. If 2 of the tenants are out, then the other 2 have got to afford 4 mortgages. Whereas if you've got 15 properties with 40 tenants in, and you lose 4 or 5, you won't have the knock-on effect that the single lets will have had, the smaller tenants or the accidental landlords, or the ones that are only have a couple of properties. So I believe that the lenders will actually switch over and believe that actually these are good tenants, landlords, these are the ones that we actually want, because the issues that have arisen, the voids and that, I don't believe will happen as much. The second part of it, it's going to be, at the moment, there isn't a way around it, because if we go, what I mentioned earlier, so for instance, a lot of the lenders are now signing up to this e-tech system, and it doesn't matter if you have properties in personal name and limited company name and LLP name, or 5, 6 different company names. When we submit it, we have to put every mortgage that you've got an interest in, or every property, sorry, you've got an interest in. So there isn't a way of diluting your portfolio to present it to the lenders. At the moment, you've been limited, and it goes back into over 10 properties has really been regarded more as a business application rather than a landlord application or investor application. It's been run as a business. That's where your main income comes from. Or that's the view they take, and the only thing I can compare it to is the old commercial mortgages, where it is a trade-in business deal. And unfortunately, large landlord portfolios are now in that market. But as I said, I think the lender's view will change going forward, and they will become the sort of area of business that a lot of the lenders will want, and that will make it more competitive and bring the rates down.
Richard, so that sounds like a little bit of good news for you potentially. Okay, we've just got time for one more question. This is from Runa, and it's a specific question about her position as a HMO landlord. She's saying she's got 6-bed HMO, 2 rooms have been vacant for a couple of months now. She's not requested a payment holiday, unlike some. So will this be looked at negatively with the voids with any new lending she decides to potentially apply for?
No, it won't be looked at negative. It will be looked as a positive, because you managed your business and your portfolio through a void period and not needed assistance, and that's regarded as, your business model works. What some people are forgetting with the payment holidays is, with the new stress level testing that was brought in, i.e. stressing it out at 5.5% at 125 or 145% coverage, this was meant to cover the void periods. Because it was stressed out and you were making, or should have been making, the money out of the rent every month, this was meant to cover periods like this, although no one expected it this bad. So if you've got through this without having a holiday period, it will be looked on far better than people that have had the holiday period payments. I always give the scenario that if I was an underwriter and I'm sitting down with 2 identical deals, one's had a payment holiday and one hasn't, I know which deal I would back first. That's the only way I can sum it up. And I think it's a positive if you don't take the payment holiday and keep everything up to date.
Okay, Karl, thanks for that. Just got one more short question.
Okay.
I think This is from Fiona, and then we'll go on to presentation from John Corey. So Fiona's question is quite simply about the well-publicised bounce back loans that Rishi Sunak announced a few weeks ago. Fiona's question is, will lenders take a view on seeing bounce back loans coming onto people's bank statements?
Unfortunately, to answer the question, I can't answer it categorically because the lenders haven't had time to give any indication out of whether they will look at that negatively or not. Because in some situations, someone's business might be part investment, i.e. part as a landlord and part as something else, a trading business type, and it could have been, it's what it's used for and why it was requested. Will they ask for what, scenarios of it? I don't know. I think over the next 4 to 8, but anyway, between say 6 and 12 weeks, the criteria and requirements when processing an application will change and increase, and it will be asked questions like, have you had the payment holidays, have you had the bounce back loans, and what's your business plan and all of that. So all I can say is I can't answer the question, but wait and see with the criteria changes. Unfortunately, what's happened again, like with the payment holidays and the bounce, it's been offered by the government without knowing the consequences. And unfortunately, we won't know that until we're moving it, by which time some people have already had it. And that's the unknown, unfortunately.
Okay, Karl. Fiona, I hope that's helped to part answer to your question. So just to finalise, that was Karl Griggs from CPC Finance. Karl is the founder of CPC Finance. They're a regular advertiser within Property Investor News, and property that showed earlier was put together by the case study over in was it West Drayton, that one, Karl? I'm trying to remember now.
Windsor.
Windsor, yeah. So the developers that did that project, we featured in the magazine last summer with another one of their projects, HMO projects in West Drayton. That's Malkit and his partners. So Karl, thanks very much for the presentation tonight. Hope people got some value out of it. By the looks of it, there's some interesting questions. So as always, time on these things moves quickly. So thanks, Karl, and